Realty Income is one of the most popular REITs in the world, and it's pretty simple to understand why. The company has managed to pay a growing monthly dividend for 30 plus years in a row, and not even the great financial crisis or the pandemic could stop its dividend growth. And O stock is not just a boring income investment, it's one of those dividend growth stocks that has also managed to generate much higher total returns than the broader stock market, outperforming the S&P 500, Berkshire Hathaway, Walmart, and many other highly successful companies. Today, the company is bigger and better diversified than ever, it has an A-rated balance sheet, and despite that, it's actually offered at a historically low valuation, offering a near 6% dividend yield. Therefore, it may seem like a no-brainer to a lot of investors, and I agree that it makes sense for some of them. However, it's not my favorite. There are several companies in its peer group that have very similar business models that expect to generate even higher returns going forward. Hey everyone, this is Yus. I run a small investment firm that specializes in REIT investing. In today's video, I'm going to talk to you about 3 REITs that I like better than Realty Income. But before I get into it, please let me know in the comment section below what REITs you would like me to cover next. I'm currently working on Prologis, Vici Properties, Unity Group, RCI Hospitality. Let me know if there's any other company that you would like to see covered, and I'll start working on it. And then secondly, if you'd like to support my channel, I would really appreciate it if you click on the like button. It really helps me to produce all this free content for you. Thank you so much in advance. So the first REIT I'm going to discuss here is called Vici Properties, ticker symbol VICI. This is the biggest net lease REIT that specializes in casinos. It owns some of the trophy assets like the Caesars Palace and the Venetians on the Las Vegas Strip, but as well as some regional casinos. And it has a really good track record, easily beating that of Realty Income since going public. It has historically managed to generate 15 to 20% average annual total returns thanks to its rapid growth. However, now the REIT has become very big in size, and therefore I expect its future growth to slow down, just like that of Realty Income. But there are 3 key reasons why I expect Vici to keep delivering higher total returns than Realty Income in the future. Firstly, Vici has mostly CPI-based rent adjustments in its leases, whereas Realty Income has mostly fixed rent hikes, and therefore I expect Vici to enjoy faster organic growth going forward, which makes it a bit less dependent on property acquisitions to keep on growing. Secondly, Vici has also stronger leases than those of Realty Income in that they enjoy stronger lease terms. They are true triple net, whereas Realty Income has a mix of triple and double net. Most of them are triple net, which means that the tenant is responsible for all property expenses, including even the maintenance of the property. But in some cases, it also owns some double net, in which case the landlord, Realty Income in this case, also has some responsibilities such as the maintenance of the parking lot or the roof or the structure as an example. Realty Income has a mixture of double and triple. Vici is purely triple, so its tenants are responsible for everything. And not only that, but its leases also force its tenants to reinvest millions into capex every year to keep its properties desirable. For this reason, I expect Vici to experience less leakage from expiring leases than Realty Income over the long run. And thirdly, Vici is focusing on casinos, which are big ticket investments, and because of this I think that its large size is less of an issue than in the case of Realty Income. Vici, when it's buying a trophy casino property, that property will typically sell for hundreds of millions or even billions in some cases, such as the Venetian, whereas when Realty Income is buying net lease properties, in most cases the single property is going to sell just for a few millions, 5 to 10 million, so it needs to buy a much larger volume of properties to keep the ball rolling, and that makes it a lot harder when compared to Vici Properties. And so historically, Vici has been able to grow its dividend quite a bit faster than Realty Income, and I don't see this ending anytime soon. But despite growing at a faster pace, Vici is today actually priced at a very similar valuation and similar dividend yield as Realty Income, and therefore I expect its combination of similar dividend yield coupled with faster growth to result in stronger total returns going forward. You could of course make the argument here that yes, Vici is more rewarding, but it's also riskier than Realty Income, and I would agree with you. However, my answer to that would be that the risk profile really isn't that different between Vici Properties and Realty Income, because yes, Vici is not quite as well diversified as Realty Income. However, the properties of Vici Properties are truly mission critical to its tenants, and this was well reflected in the performance during the pandemic. This was, when you think of it, really the worst possible crisis for casino net lease REIT, and yet all the tenants of Vici Properties kept paying their rent in full and on time. It was one of the very few net lease REITs to enjoy 100% 90% rent collection rate. Not even Realty Income was able to collect all of its rents. And for a while, its rent collection rate dropped by 20 to 30%, which in a way shows you that even Realty Income is perhaps riskier than Vici Properties. I wouldn't go that far, but my point is that the difference in risk profile really isn't that significant, yet Vici Properties is quite a bit more rewarding, and for this reason, I think that offers better risk to reward today. Then the second REIT that I expect to outperform Realty Income going forward is called Realty. Its ticker symbol is ADC. In a way, this is a much smaller version of Realty Income, and this brings me to my first point why I expect it to outperform going forward is that it's much smaller in size, and therefore it's not sharing the same size issue of Realty Income. As I mentioned earlier, Vici Properties and Realty Income are both very large REITs with market caps of tens of billions, and the problem there is that net lease REITs grow mostly by acquiring more properties, and therefore the bigger you are and the more volume of assets you must buy. However, there are only so many properties available for sale at any given time, and therefore if you're very big, your growth will inevitably slow down. However, Realty today is big enough to be well diversified, but it's not that big that it would really hurt its growth prospects, and therefore expect it to grow faster going forward. I think that this is also the main reason why Realty was able to earn much higher returns than Realty Income over the past decade, because that's really when size started to become an issue for Realty Income. And since Realty Income is today bigger than ever, I think that this will remain a disadvantage far into the future. So the smaller size is the first main reason why I prefer Realty. Then the second most important reason is that it actually owns quite a bit better assets than Realty Income, because Realty Income used to be quite comparable to Realty in terms of quality. However, over the past many years, as the company grew larger, to make up for its need to acquire more properties, it had to expand into other property sectors. It started to also acquire quite a bit riskier assets, and as a result, I think that its average portfolio quality has deteriorated quite a bit. If you look at characteristics like the percentage of revenue coming from investment graded tenants, it had dropped quite a bit for Realty Income. And today, if you compare Realty Income to Realty, you'll see a very clear difference there. I'll put a chart or a table on the screen where you'll see some of the key differences there, but very clearly Realty has a better portfolio, and not only that, it also has a stronger balance sheet. And this is the third reason why I prefer Realty, is that it has less debt, it has much fewer debt maturities coming in the coming years, and therefore it's going to be also less impacted by the surge in interest rates. And so if we recap now here, Realty is a smaller in size. It has but despite that, it's still well diversified. So its size is just more optimal than that of Realty Income to generate strong risk-adjusted returns. Then on top of that, a stronger balance sheet. It has a stronger portfolio. It's going to enjoy faster growth prospects. And despite that, their valuations really aren't that different if you adjust for the fact that Realty owns higher quality properties, which naturally trade at lower cap rates as well, and it has less leverage. Really, their earnings multiples then are fairly similar. Sure, the FFO multiple of Realty is slightly higher, but this is really, again, just because it owns better assets, has lower leverage. On a price to NAV basis, so relative to the net asset value, it's not that different. Therefore, since the valuations are not that different, I would expect Realty's outperformance to continue in the future. I just don't see a reason why it would end anytime soon. And so, in a way, I think that Realty here is a safer REIT, given that it has less leverage and better quality assets, and yet it's also expected to be more rewarding. In an efficient market, you would expect lower risk to be rewarded with lower returns, but in this case, I think that's actually the opposite, and that's simply because Realty has not been priced at an adequate premium relative to Realty Income. And then the third REIT that I expect to outperform Realty Income going forward is called Essential Properties Realty Trust, ticker symbol EPRA. I kept it for the last one because it's really my favorite net lease REIT. It's been our largest position at high yield landlord for a long time. By the way, if you want to access our full REIT portfolio, you can join us for a 2-week free trial. I'll put a link to it in the description of this video. EPRT is a unique net lease REIT in that it focuses on smaller middle market tenants instead of the major chains like Walgreens, CVS, Dollar General that most net lease REIT investors are targeting. And this unique approach brings many benefits because there's far less competition for these assets, and there isn't really even a market for them. And so in most cases, EPRT will originate its own deals by simply cold calling efforts, calling thousands of property owners and buying the properties directly from the property operators via sale and leaseback transactions. This then allows EPRT to structure its own leases in ways to maximize returns, all while mitigating risks. The higher returns here are the results from higher cap rates, faster rent escalations, and lower landlord responsibilities. And on the other hand, the lower risks are the result of buying below replacement value, having access to the unit level profitability of the real estate, corporate guarantees, and master lease protection. If you're not familiar with master lease protection, what this essentially means is that you put many properties under one lease, and therefore if the tenant wants to stop operating one property, it has to give up on all of them. And so this will often prevent tenants from leaving one property, since it would then lose other profitable assets. So this provides additional protection for the landlord. So essentially, EPRT is able to make up what it's lacking in the credit quality of its tenant by structuring stronger leases and cherry-picking properties that are highly profitable at the property level by having access to the unit level profitability of its properties. This often isn't the case with strong, big-name tenants like Walgreens or McDonald's. Typically, these tenants have much more bargaining power with landlords, and they won't even provide the unit level profitability. And so quite often you'll end up buying a property not really knowing how profitable it is, and so you're gambling that hopefully the property is doing well and the tenant will renew your lease once it expires. But if the property is not doing well, they might as well just then end the lease and move elsewhere. And so in a way, it really mitigates risks quite a bit to have access to the unit level profitability of its tenants. And so here are the results of EPRT's unique approach relative to that of Realty Income since it went public, and you'll see that there is a very significant performance gap here. EPRT has massively outperformed because it's been able to grow at a far faster rate, and it's also smaller in size, so new acquisitions really truly move the needle for it. And I don't see this outperformance ending anytime soon because EPRT enjoys faster rent escalations and it's able to earn larger spreads over its cost of capital in today's environment. Its valuation is slightly higher, its dividend yield is a bit lower, but again, I think that the difference here is not large enough to make up for Realty Income's lower growth relative to EPRT, and therefore I think that the company offers better return prospects going forward. Just like in the case of Vici Properties, you could of course make the argument that EPRT is also riskier than Realty Income. I would agree with you, but once again I would point to the performance during the pandemic because again, this was the worst possible crisis for net lease investors, and yet the model of EPRT proved to be quite successful even through this crisis. Its rent collection rate dipped temporarily, but it was then able to collect most of its deferred rent payments, and it even grew faster than Realty Income through this crisis. So yes, risks are a bit higher, but the rewards are a lot higher, and so I think the balance of the risk to reward is superior in the case of EPRT. So these were 3 net lease REITs that are better than Realty Income, but there are many others, and if you want to access our full portfolio, you can join so by joining High Yield Landlord for a 2-week free trial. It will give you immediate access to our entire real money REIT portfolio, as well as all our transactions in real time. Finally, if you thought that this content was valuable, I'd really appreciate if you click the like button, subscribe to the channel. Thank you so much in advance. See you at my next one. Bye-bye.